Tulip Mania. Picture this: 17th century Netherlands. The Dutch Golden Age is in full swing. Trade is booming, the country is wealthy, and people are obsessed with luxury. Among all the fancy goods flooding into the markets, one thing caught everyone's eye: tulips. But soon, tulips weren't just about gardens anymore. They became investments. Rare bulbs started selling for insane amounts of money. At one point, a single tulip bulb could cost more than a house in Amsterdam. Some were trading hands for the modern equivalent of hundreds of thousands of dollars. People of all classes wanted in. Merchants, artisans, even servants started buying bulbs on credit, convinced they'd flip them for a profit. The excitement was contagious. After all, who doesn't want to get rich quick? But here's the thing with bubbles: prices don't rise forever. In February 1637, confidence cracked. At an auction in Haarlem, nobody was willing to pay the absurd prices anymore. Just like that, demand vanished. Within weeks, tulip bulbs were worth almost nothing. Historians later discovered that the actual financial impact was over-exaggerated. And the entire event became a cautionary tale about greed and irrational markets. The South Sea Bubble. Fast forward about 80 years to England. The British Empire is expanding and investors are hungry for opportunities. Enter the South Sea Company. The pitch was simple. The company had been granted a monopoly to trade in South America. Think gold, silver, exotic goods. Investors were told they'd be swimming in riches. There was just one problem. Britain didn't actually control those territories. Spain did. The company's profits were more fantasy than reality. But hype is powerful. The South Sea Company promised not just trade wealth, but also a clever scheme to reduce Britain's national debt. Investors, including politicians and members of the royal family, lined up to buy shares. Stock prices skyrocketed from £100 to nearly £1,000 in a matter of months. Even Isaac Newton, one of the greatest minds in history, and got swept up in the frenzy. He initially made a nice profit when he sold his shares early. But then, as the price kept climbing, greed pulled him back in. He reinvested heavily, only to lose a fortune when the bubble burst. Newton later admitted, "I can calculate the motions of heavenly bodies, but not the madness of men." By late 1720, reality caught up. The South Sea Company had no profits to show and confidence evaporated. Shares collapsed, wiping out fortunes overnight. Thousands of investors, from wealthy aristocrats to everyday citizens, were ruined. The scandal was massive. It led to public outrage, parliamentary investigations, and the British government had to step in to restore order and confidence. The Panic of 1907. New York, 1907. Banking back then worked on trust more than rules. There was no Federal Reserve, no deposit insurance. If people thought their money wasn't safe, there would be a bank run, and the bank would collapse. The trouble started when a group of speculators tried to take control of the copper market. Their plan failed badly, and word spread that the banks backing them were shaky. Panic set in. People lined up to pull out their deposits. And once a few banks fell, fear spread to others. What's interesting is how the crisis was stopped. It wasn't the government that saved the system. It was one man, J.P. Morgan. At the time, he was the most powerful banker in America. He called together the heads of the big banks, locked the doors, and basically told them, "We're not leaving until we figure this out." They agreed to pool money to rescue failing banks and restore confidence. It worked. But the panic showed just how fragile the financial system was. Relying on one man to stop a national collapse wasn't sustainable. That scare was one of the main reasons the Federal Reserve was created in 1913. The Great Depression. It started with Black Tuesday, October 29, 1929. The 1920s had been a boom decade. People were making money in the stock market, and more ordinary Americans joined in. Many didn't just use savings. They borrowed heavily to buy stocks, convinced prices would only keep climbing. When stocks began slipping in late October, nervous investors rushed to sell. On Black Tuesday, a record 16 million shares were traded, and prices collapsed. Billions of dollars in wealth vanished in a matter of days. Unlike earlier crashes, this one didn't bounce back. The fallout was brutal. By the early 1930s, 1 in 4 Americans was unemployed. Banks failed in the thousands, and people lost their life savings. Families lined up at soup kitchens. Around the world, trade collapsed and economies sank into depression. The government eventually stepped in with big reforms. Roosevelt's New Deal created programs like Social Security and unemployment insurance. Regulators also cracked down on Wall Street, setting up the SEC to police the markets. But it wasn't until World War II that the Great Depression finally ended. The crash of 1987. October 19, 1987 is remembered as Black Monday. On that single day, stock markets around the world went into free fall. The Dow Jones Industrial Average in the US dropped more than 22% in just one trading session, the largest one-day percentage drop in Wall Street history. To put that into perspective, that would be like the Dow losing over 7,000 points in one day today. So what caused it? A mix of factors. One big culprit was the rise of program trading. This was the early era of computers on Wall Street. Traders had set up automated systems that would sell stocks once prices started falling, hoping to limit losses. The problem is, when the market dipped, those programs all triggered at the same time. Instead of calming things down, they created a domino effect. The more the market fell, the more computers sold, which pushed prices down even faster. But it wasn't just technology. Investors had been nervous for months. Interest rates were rising, trade deficits were widening, and people feared the stock market had grown too hot. When panic set in, the combination of human fear and machine-driven selling turned a correction into a historic crash. Unlike the Great Depression, this crash didn't lead to years of economic misery. Within 2 years, markets had recovered. That's partly because the US Federal Reserve responded quickly, pumping liquidity into the system and reassuring investors that they'd keep credit flowing. On that day, Hong Kong's market fell by 45%, Australia's by 41%, and the UK's by 26%. It was the first truly global stock market crash, showing how interconnected the world had become by the late 20th century. The Asian financial crisis. For years, many countries in Southeast Asia, Thailand, Indonesia, South Korea, Malaysia, had been booming. They were known as the Asian Tigers because their economies were growing at lightning speed. Foreign money poured in, fueling real estate projects, new businesses, and rising stock markets. But much of that growth was built on shaky ground. Many of these countries pegged their currencies to the US dollar to keep them stable. At the same time, banks and companies borrowed heavily in dollars, confident their currencies would stay strong. When confidence began to crack, everything unraveled quickly. It started in Thailand. In July 1997, the Thai government was forced to devalue the baht after it could no longer defend its currency against speculators. That move shocked investors, who quickly pulled money out of other Asian countries, fearing they might be next. Currencies collapsed, stock markets plunged, and businesses that had borrowed in dollars suddenly found themselves drowning in debt they couldn't repay. The crisis spread like wildfire. Indonesia's rupiah lost over 80% of its value. South Korea needed a record-breaking bailout from the International Monetary Fund. Millions of people lost jobs, and poverty levels soared almost overnight. The middle class in many countries was wiped out. The dot-com bubble. By the late 1990s, the internet was becoming mainstream. For the first time, people could buy things online, send emails, and explore a digital world that felt unlimited. Investors looked at this new frontier and thought, whoever gets in early is going to get rich. That mindset fueled the dot-com boom. Companies were adding .com to their names just to attract attention, and it worked. A tiny startup with no profit could suddenly be valued in the hundreds of millions. Venture capital firms poured billions into internet businesses that hadn't figured out how to make money. One of the most famous examples was Pets.com. It seemed like a smart idea, sell pet food online. But the math didn't add up. The company was spending more on shipping a bag of dog food than it earned from the sale. Still, investors bought in, convinced growth mattered more than profit. The Nasdaq, which is where most tech stocks trade, almost quadrupled between 1995 and 2000. People were quitting their jobs to become day traders. It felt like a once-in-a-lifetime opportunity. But by early 2000, cracks started showing. When companies kept reporting losses quarter after quarter, reality caught up. The bubble popped in March 2000. Within 2 years, the Nasdaq lost nearly 80% of its value. The human cost was brutal. Many ordinary investors lost their savings. Employees who thought they were millionaires because of stock options suddenly had nothing. Retirement accounts got wiped out, but not everything disappeared. Some companies with real business models survived. Amazon's stock fell by more than 90%, yet it kept growing and adapting. Google was just starting out and proved to be a long-term winner. The dot-com bust cleared away the noise and left behind the firms that would truly shape the internet. The global financial crisis. Fast forward to 2008, and this time, the bubble wasn't about tech stocks. It was about housing. For years, banks in the US had been making it easy for almost anyone to buy a home. Mortgages were being handed out with little proof of income or assets. These risky loans were bundled together into financial products called mortgage-backed securities. On paper, they looked safe, and big institutions around the world invested heavily in them. The problem was that many of these loans were never going to be paid back. When homeowners started defaulting, the whole system began to unravel. Housing prices, which everyone thought would only go up, suddenly started falling. That meant people owed more on their mortgages than their homes were worth. In 2007 and 2008, major banks and investment firms began collapsing. Bear Stearns and Lehman Brothers, two giants of Wall Street, went under. Lehman's bankruptcy was the largest in U.S. history and sent shockwaves through global markets. Credit froze. People and businesses couldn't borrow money. Stock markets around the world went into free fall. Millions lost their homes. Unemployment skyrocketed. Retirement accounts shrank overnight. For many families, it felt like the ground had disappeared beneath them. The Euro area crisis. After the 2008 financial crash, Europe faced its own storm. The euro was still relatively new, and the idea was simple. One currency would tie countries together, making trade and travel easier. But there was a catch. While these countries shared the euro, they didn't share the same budgets, debt rules, or economic strength. The crisis began when Greece revealed in 2009 that it had been understating its debt for years. Investors suddenly realized the country owed way more than it could possibly pay back. Confidence collapsed almost overnight. Bond yields, basically the cost of borrowing, skyrocketed for Greece. Soon after, other heavily indebted countries like Portugal, Ireland, Spain, and Italy came under fire too. For ordinary people, the crisis meant harsh austerity measures. In Greece especially, pensions were cut, salaries were slashed, and unemployment soared. Protests filled the streets of Athens. People felt like they were paying the price for mistakes made by governments and banks. What helped calm things down was a turning point speech by Mario Draghi, head of the European Central Bank. In July 2012, he famously said the ECB would do whatever it takes to save the euro. That promise reassured markets and gave governments room to stabilize their finances. Bailouts were arranged, debt restructuring was done, and slowly confidence returned. The COVID crash. The most recent major financial shock came in early 2020. And unlike past bubbles, it wasn't driven by speculation or bad loans. It was caused by a global health crisis. When COVID-19 spread across the world, countries went into lockdown. Planes were grounded, offices shut down, and entire industries came to a halt almost overnight. The financial markets reacted with sheer panic. In March 2020, stock markets saw some of the fastest declines in history. The S&P 500 in the US fell by about a third in just over a month. Oil prices even briefly went negative because demand had collapsed so badly that producers had nowhere to store excess supply. What made the crash unique was the speed and the uncertainty. Nobody knew how long the pandemic would last or how badly economies would be damaged. For ordinary people, it meant sudden layoffs, closed businesses, and financial stress. Restaurants, travel companies, and small shops were hit the hardest. Governments and central banks responded with massive interventions. In the US, trillions of dollars were pumped into the economy through stimulus checks, business loans, and unemployment support. The Federal Reserve slashed interest rates to nearly zero and started buying huge amounts of assets to stabilize markets. Similar measures were taken in Europe, Asia, and elsewhere. By the summer of 2020, markets had already begun to recover, even while the pandemic was still raging.